Oh hi, I'm the heretic. Around 2007-2008, the collapse of property values in the US real estate industry caused domestic financial institutions, as well as foreign ones invested in the US housing market, to take significant losses. The result has been arguably one of the most significant downturns in US economic history. The event goes by many names: the 2008 financial crisis, the subprime mortgage crash, the Great Recession. Chances are you've heard these names at least once. But the fact of an economic downturn as a result of the cratering of the real estate industry is one of the few things economists and historians can agree on in regards to this event. But there is no shortage of propaganda, narratives that attempt to explain the cause of the crash but are full of misinformation. And how will people know any better? The actual causes seem so arcane, you need a 4-year undergraduate degree in finance just to begin to understand what a collateralized debt obligation, mortgage-backed security, or a subprime loan is. Often, all that's necessary to propagandize is to stun people with the clarity at which one spews finance jargon. Well, I didn't understand a word of that, but he sounds smart, so he must be right. Well, today, we're going to tackle the 2008 financial crash. It is complex. There are multiple factors and layers, many different people spanning multiple generations. There's no one single event that caused everything to go out of control, so if you come here expecting a single, simple explanation, well, there won't be one. But after watching this video, you'll be better educated as to what happened, who was involved, and what groups were responsible. You'll also understand the false narratives and where they go horrifically astray. Perhaps most importantly, you'll understand how this relates to today. This is a story of lies and betrayal, of useful idiots and good intentions gone awry, and the rewriting of history in real time. Let's begin, shall we? What better place than where all the economic devastation over the last 100+ years began? In 1913, the Federal Reserve Act was passed, establishing the Federal Reserve System, otherwise known as the Fed. They're the central bank of the United States. Now, the details of its formation, how the Morgan banking family sought to solidify its power through creating government-sponsored cartels, that's a story for another time. However, there are salient points you need to know. Firstly, the mission statements of the Federal Reserve are to promote maximum employment. Now, this comes from their own publication. According to the Federal Reserve, the very first reason they listed for their control of monetary policy is to maximize employment. An economy can have full employment tomorrow. Just pay the unemployed $1 an hour to sit on their hands. Bam! Employment solved. Of course, this doesn't actually produce any goods or services, and the cost of employing these hand-sitters is a net loss to the economy. What actually produces wealth is production, not employment. Anyways, back on topic. The Federal Reserve's purpose, according to the Federal Reserve, is to promote maximum employment, stabilize prices and interest rates, keep the finance system stable, and a whole bunch of other pleasant-sounding bromides. Perhaps most importantly, the Federal Reserve is the lender of last resort, meaning that if banks or financial institutions owe more than what they have in assets, the Federal Reserve will give the institution a loan to make up the difference. For example, suppose I owe Bob $100, but I only have $50, because I gave the other $200 I had as a loan to Jim, who says he'll pay me back $250. So that means I'll eventually make a $50 profit. It's a good business model until Bob asks for his $100 and Jim hasn't paid me back yet. Well, the Federal Reserve as a lender of last resort, gives me a loan of $100 so I can give Bob what I owe him. It's like putting your credit card debt onto another credit card. The problems with this will become readily apparent later. Now, the Federal Reserve is a cartel of banks that collectively holds a monopoly on the supply of money and the interest rates of money. I'll put a thing on screen if you're unclear what interest rates are. In the absence of central banking, interest rates would be set by lending institutions based on rates of saving versus borrowing at any given period of time. Instead, it's arbitrarily determined by bankers based on what they unilaterally determine to be in the economy's or their own interest. In addition, the Federal Reserve has the exclusive right to print US dollars into existence to increase the supply of currency. Ostensibly, the Federal Reserve is independent, privately owned, but the Federal Reserve Chairman, as well as its Board of Governors, is appointed by the President of the United States, and who owns the Federal Reserve is unknown. How interest rates were manipulated and how the lender of last resort brought down the whole US financial industry won't be relevant to this story for another few decades, but the groundwork is laid. Now, let's jump ahead to 1934. We're in the midst of the Great Depression. Franklin Delano Roosevelt is president, and the National Housing Act is passed as part of the New Deal, creating the Federal Housing Administration, or FHA. The express purpose of the National Housing Act was to solve the home ownership crisis happening at the time by requiring mortgage lenders to lower their standards for borrowing, something I'm sure we'll see again soon. However, these lower standards were only done in select neighborhoods. In the underwriting handbook distributed to appraisers, the FHA included in its appraisal criteria the likelihood of neighborhood value deterioration, explicitly stating that minorities moving into a neighborhood constituted lowering property values and therefore higher risks. They divided neighborhoods into one of 4 color-coded zones. Green, racially homogeneous areas with homes lived in by professionals that are still partially under construction. Blue, desirable areas that were expected to maintain their value for many years. Yellow, areas judged to be declining, often sparsely populated and situated next to red neighborhoods. Red, the decline is complete. Low incomes, crime, and economic destitution are the norm. This had the effect of segregating people by race into certain neighborhoods, as banks were required by legislative and regulatory fiat to provide mortgages at discounted rates only in green and blue approved neighborhoods. The underwriting handbook made explicit mention of the infiltration of a lower grade population, or lacking homogeneity, when describing certain color codings. It was repealed in 1968 following the passage of the Fair Housing Act, but nevertheless, the perception was in place, fostered over 3 decades that lenders were racist and engaged in active discrimination. This was absolutely true, though how the federal government forced banks to lend to people in favored green and blue white neighborhoods over yellow and red black neighborhoods is nearly forgotten. Gail Chincata and Shel Trapp certainly forgot about it. The two of them would establish National People's Action in 1972, sometimes known as National People's Campaign, a community organizing group based in Chicago that still functions to this day under the name People's Action Institute. Gail Chincata, a trainee of Tom Gaudet, one of Saul Alinsky's disciples. You know Saul Alinsky, right? The Marxist who wrote the user manual for totalitarianist ideologues, whose 4th rule was to not have any principles but to hold their enemies to theirs, that the ends justify the means, his magnum opus being dedicated to Satan? Yeah, that one. How can people believe evil doesn't exist when it presents itself to our faces? At the bare minimum, it means the Marxists and SJWs we're dealing with today literally have an instruction manual. Nonetheless, National People's Action, or NPA's goal at the time was to democratize capital, which amounted to bullying banks until the NPA got paid off, threatening the banks' reputations with allegations of lending standards based on race. The strategy was simple: agitate people into protesting against a bank, arguing the bank was engaged in redlining and blockbusting. Redlining being the practice where banks would make loans based on racial favoritism, and comes from the color-coded neighborhood demarcation of the 1934 National Housing Act. More specifically, inner-city black neighborhoods, often being marked as red neighborhoods, if you recall. Blockbusting is when banks rumor monger that blacks are moving into a neighborhood to encourage people to sell their property for cheap to banks who resell it to blacks for a profit. The NPA's overarching narrative being that poverty in inner-city neighborhoods, which were predominantly black, was the result of racism on the part of lending institutions, especially in Chicago, where this activism was most prevalent. Not wanting to risk their reputation as an institution from allegations of racism or deal with costly discrimination or defamation lawsuits, banks would pay the NPA, Jesse Jackson, Acorn, and other agitators up to 6 figures to leave them alone, in addition to making agreements to make more loans to minorities. Then the activists would move on to their next bank. In April 1975, the NPA hosted a conference which promoted legislative action, Chinkata, stating, "We need a strong federal anti-redlining statute," even though redlining was already illegal at the time, also announcing her plan to testify before the Senate Banking and Currency Committee in May of that year in favor of what would become the Home Mortgage Disclosure Act of 1975, or the HMDA. This legislation required banks to keep records on applications for residential mortgages, including ethnicity, race, what kind of loan was applied for, and whether or not they received the mortgage, among other information. They would then be required to, annually, submit these records to the federal government, who would make these records public. The branch office in each bank was in addition required by legislation to prominently feature a poster detailing how to obtain HMDA records. This, of course, revealed to community agitators that racial minorities received mortgages at lower rates than whites, even when adjusting for income. So, case closed, right? We have it on public record that banks are engaged in redlining, surely. While banks do look at income level when deciding whether or not to take out a loan, a bigger influence is credit score, which is just a way for lenders to know how likely you are to pay them back. Trouble is that banks were only required to keep records of loan applicants' credit scores starting early 2018, 10 years after the financial crisis. Prior to that, clients' credit scores were not public information. Given that minorities tend to have lower credit scores than whites, it explains the racial gap in loan approvals. Once adjusted for credit scores, the gap vanishes. So if I'm in 1976 and I want to know if Bob's First National Community Bank is redlining, I compare the rates of loan turndowns between applicants of equal income levels. After seeing this data, including racial data, and not knowing the credit scores of the applicants because that information wasn't disclosed, racism seems like a reasonable explanation. Study after study by media outlets and activist groups back this up. This brought about renewed allegations of racism on the part of banks, which of course brought more shakedowns. While academics and banks did reply that these studies failed to take into account credit scores, as mentioned earlier, the damage was done. In 1977, the Community Reinvestment Act, or CRA, was legislated into existence. The bill was written by Gail Chincata and Shel Trapp, the same Chincata and Trapp who founded the National People's Action, if you recall. The purpose of the legislation was to compel banks in the U.S. to make loans to people in their locality and to submit their records of doing so to the Federal Deposit Insurance Corporation, or FDIC. Failure to sufficiently meet CRA requirements to the satisfaction of FDIC bureaucrats meant mergers, expansions, or acquisitions were denied. While that seems mild, the U.S. banking industry relies on mergers and expansion to survive. Continuous denial is basically a death sentence. With the Community Reinvestment Act, government agents from the alphabet soup, such as the Federal Reserve, the FDIC, or others, were empowered to see if a bank was serving the needs of their community, effectively using government statutory fiat to determine banking lending policy. Community agitator groups like the NPA now had a say in how private businesses operated, and by agitating people into telling government agents, no, they are not serving our needs, they could prevent banks from expanding or merging. Simply threatening to do so would have been enough to coerce businesses into paying off their agitators or risk a collapse in their valuations. The earliest example of the FDIC using this power is in 1979, when they stopped Greater New York Savings Bank from opening a branch in Manhattan for failing to make enough loans in their neighborhood of Brooklyn. Why? A private business needs to beg permission from government bureaucrats to do what they need to survive? Because government. Yeah, that makes sense. In 1980, the next year, a Maryland bank was prevented from expanding because they didn't provide loans for people in Washington, D.C. The bank didn't even have a branch in the city. The CIA required banks to serve the needs of the community, but the legislation wasn't even 3 years old before the alphabet soup started dictating which communities ought to be served. Even if the bank had no presence in that area, or even if they didn't provide lending services at all. So now let's take a step back here. We know that community agitators like the NPA, are using the principle of housing is a right as a way to shake down banks for money. But this is harmful, not just to banks, but to depositors and borrowers as well. When the bank is forced to make loans to people who will, on average, have lower credit scores, it means that there's a less chance of the loan being paid back. When these loans can't be paid back, when they're defaulted, the bank has to take that loss. Given enough of these losses, even charitable institutions not concerned about profit won't be able to keep the lights on. And this harms the poor, the very minority communities agitators are trying to help, or at least they say they're trying to help. Even if banks didn't shut down, they're still hurt by these loans they're required to take out, limiting their capacity to make loans in the first place. Whose money is it that's being loaned out anyway? The banks? No, it's depositors. Of course it's depositors. When a bank does make loans to risky clients, they'll often do so at a higher interest rate, meaning every year the loan is not paid back, someone with a bad credit score will pay more to pay the loan back than someone else with the same loan amounts but with a better credit score. This is done so even if the loan isn't paid back in totality, the bank gets something from the payments. Again, credit score just gives a rough estimation of how likely this guy will pay back what he owes. When a client has an above average risk of not paying back the mortgage, but a mortgage is given anyways, this is called a subprime mortgage. Now keep this term subprime mortgage in mind, because I'll be referencing it a lot later. So when banks are coerced by government legislative fiat into giving more loans to people with bad credit, they're issuing more subprime mortgages. The mortgages are given out with higher interest rates, and the mortgages are often used to pay for things that the borrowers otherwise couldn't afford. I mean, sure, it's great for someone with a bad credit score to move out from a cramped apartment to a 2-story house, but what happens to the family who can't pay back the interest on the mortgage for their house? The banks lose money. Families are ruined with mortgages they can't afford. It's absolutely wretched. But hey, God Empress Chinkara got her tribute, and the senators who passed the CRA get to feel warm and fuzzy inside from helping brown people get houses, so everything is just swell. If National People's Action were interested in helping people, they would offer free financial counseling, encouraging minorities to save their money, pay down debts, and encourage habits of frugality. These habits would not only increase their credit scores, thus making it easier for them to get loans at lower interest rates, but also encourages people to have a longer or lower time preference, encouraging more speculative investment, wealth creation, and eventually the breaking of the poverty cycle itself. But of course, that kind of stuff requires effort and telling people the truth. But anyways, following the passage of the CRA, community agitators doubled down on their intimidation tactics to extort $5 billion from US banks by 1990. But even before that, community agitators made it a point to lower lending standards to accommodate people who couldn't afford these mortgages. The Association for Community Organizations for Reform Now, or ACORN, pressured the regional bank Louisiana Bankshares into using more flexible lending standards. Among other things, counting government benefits like food stamps as income, or not requiring borrowers to have 2 to 3 months of mortgage payment money on hand. In 1992, Congress required the quasi-government corporations Fannie Mae and Freddie Mac to devote 30% of their mortgage purposes to mortgages of people with low incomes. Now, this might require some explanation. Fannie Mae and Freddie Mac are technically privately owned, but they enjoy unique privileges. They have special lines of credit with the US Treasury and can borrow money at interest rates lower than any other financial entity in the world. They are also exempt from several financial restrictions such as capital requirements, needing to file with the Securities and Exchange Commission, or even having to pay state and local taxes. To say they have advantages over other financial institutions puts it mildly. But Fannie Mae and Freddie Mac's purpose as government-sponsored corporations is to buy loans from banks. They pay the bank the cost of the loan and take on the risk of default themselves, or sell it to others in the global financial markets. The idea behind this is to give banks the capital they need to make more loans. If Fannie and Freddie buy 30% of loans from people of low incomes, which will include some prime mortgages, it insulates banks from the risk of those mortgages. In 1995, HUD Secretary Cisneros increased it to 42% and to 50% by his successor Andrew Cuomo. By the time George W. Bush came into power in 2001, the previously rigorous standards Fannie Mae had before buying mortgages was so dissolved they were buying mortgages that were made with no money down at all. Now imagine you're a bank, and you're forced by the state into making subprime mortgages you know won't get paid back. Your incentive is to do the minimum legal requirements and nothing more. Because even with their higher interest rates, they aren't profitable. Now imagine a third party comes along and offers to buy all of your subprime mortgages plus interest. Suddenly, you're making more money off of subprime mortgages than prime mortgages. That is, mortgages to people that are likely to be paid back. It's not your incentive, therefore, to write as many subprime mortgages as you can and then sell them to the third party? Fannie Mae and Freddie Mac were that third party, and many large banks, like Countrywide, made huge profits doing this. But who could blame them? They were only responding to the incentives the government created. The Mortgage Bankers Association in 1994 signed an agreement with the Department of Housing and Urban Development, or HUD, to make more loans to minorities as well as lower lending standards. The impetus for this was the state threatening mortgage lending companies currently exempt from the CRA to have to meet CRA requirements. HUD was headed by Henry Cisneros, who made lowering lending standards and coercing banks to give more of their money to low-income communities as part of his agenda. All of it justified by a 1992 study by the Federal Reserve Bank of Boston. The report studied 6 million loan applications, and when adjusting for income, 30% of blacks, 27% of Hispanics, and 17% of whites were denied. But this study was different. It adjusted for not just income, but credit scores, net worth, age, and levels of education. With all of those factored in, 17% of loan applications from blacks were rejected, compared to 11% of whites. While a 6% difference isn't very large and narrower than the 13% gap from before, it's still statistically significant enough that the only reasonable explanation for it must be racism. Right? Except David Horn, economist with the FDIC, in other words, an alphabet boy, found several problems with the study. Firstly, applicants with negative net worth, or where the lender couldn't verify the information given on the application and were therefore rejected, were not excluded from the study. Furthermore, 2 of the 70 banks studied were responsible for half of the black applicant denials. One of them was minority-owned. The data is therefore tainted and unreliable. The study useless. Harold Black, professor at the University of Tennessee, found that blacks were actually more likely to be denied loans at black-owned banks than by white-owned banks, rejecting one of the key premises behind the redlining hypothesis. One could argue that black-on-black racism qualifies as racism, but these are Marxists we're talking about. Yet this study, by a black professor no less, disproves that hypothesis. Furthermore, loans given at lower lending standards were at greater risk of default. In October 1994, James Johnson, head of Fannie Mae, said that mortgages with lower monthly payments were more likely to default. Other studies showed similar results, with borrowers with no or bad credit ratings being most at risk for default. Perhaps the most amusing example involved the president himself at the time. As governor of Arkansas, Bill Clinton tried to establish a charitable bank called the Good Faith Fund to offer loans and mortgages to minorities. However, 52% of the loans were never paid back, and the fund went under just after 2 years. Clearly, white-on non-white racism could not be identified, and lowering lending standards only increased the risk of default, saddling banks with losses and borrowers with debt, leaving them both worse off. Perhaps people who couldn't afford loans shouldn't have them. Maybe these lending standards existed to protect banks, depositors, and those who would take a mortgage they couldn't afford. But when have ideologues and megalomaniacs ever been stopped by facts? Janet Reno's Justice Department let slip the lawyers, who targeted even small community banks with violating anti-discrimination statutes, even when no minorities filed complaints. Yet every bank made settlements with the state, finding it cheaper to do so than go through a lengthy legal battle. The simple threat of such litigation was enough to scare banks into lowering lending requirements even further. To bring about such lawsuits, they redefined discrimination to include disparate impact. In other words, if a lending policy disproportionately affected minorities, even if zero racism were actually occurring, then they were violating the Fair Housing and Fair Credit Acts. You can see how the state shifted the burden of proof on banks to force them to prove a negative. Before, the state had to prove that banks were discriminating. Banks now had to prove that they weren't discriminating. Whatever happened to innocent until proven guilty? Mortgage lenders, previously not subject to Community Reinvestment Act requirements, took the hint. Loans were offered with tiny to no upfront deposits, while lowering mortgage standards to basically nothing. The stated goal was to increase minority ownership, which, to be fair, was working. From 1994 to 1999, home ownership among Black and Latino people increased by 2 million. The CRA was also rewritten to rate banks according to how much they loaned to poor minorities. A good score was needed if they wanted the government's permission to merge or expand. This rating, of course, became public information, while in 1995, another rewrite imposed a quota on banks to make loans in proportion with the demographics in their area of operation. Of course, what constituted their area of operation was up to the arbitrary whim of the Department of Housing and Urban Development. But once again, the state shifted the burden of proof onto banks to prove they were in compliance with government legislation. The effect was significant. Wells Fargo agreed to pay $45 billion with the California Reinvestment Committee. Star Bank in Ohio agreed to spend $5 billion in loans to the homeless, and $120 billion was agreed upon with activists in Washington State and California from Washington Mutual. Cisneros left HUD in 1997 to be replaced by Andrew Cuomo. Cisneros took a position on the board of the subprime lending firm Countrywide. Continuing where Cisneros left off, Cuomo announced in April 6, 1998, that he had settled with AccuBank Mortgage Corporation, a Dallas, Texas mortgage provider, in the largest unfair housing settlement in U.S. history. AccuBank was made to pay tribute to their divine overlords to the tune of $2.1 billion and offer loans to 15,700 families over the next 3 years, which even Cuomo admitted were at a higher risk of default. But the Clinton administration and community agitators were not completely insane, and recognized that if banks lost too much money, they'd close down and couldn't make any more loans. To remedy this, they leaned on the so-called secondary market of loans, the likes of Fannie Mae and Freddie Mac, who, if you recall, buy mortgages from banks, so that the bank doesn't take on the risk of the loan and have more capital to issue out more loans. This financial tool is known as mortgage-backed securities. If you've done any research into the 2008 financial crash, you might have heard this term once or twice. Ellen Seidman, Special Assistant for Economic Policy for Bill Clinton, is quoted as saying the following. In 1995, revisions to the CRA regulations introduced investment and service tests to the evaluation of an institution's CRA performance. These additions have spawned a new market for investment in affordable housing and economic development securities. Fannie Mae, Freddie Mac, investment bankers, and mortgage companies are offering targeted mortgage-backed securities that enhance liquidity and increase the capital available for community development. Without the CRA as an impetus, the market would not likely have developed. I wonder if that's going to be important later. All this resulted in skyrocketing levels of lending to poor people. Recall that by 1990, approximately $5 billion in loans were made that otherwise wouldn't have existed but for the CRA. Affirmative action in loans encouraged under the Clinton administration saw that number increase to $1.09 trillion in just his first few years. This, of course, did result in skyrocketing rates of minority ownership. And all this happened under the Clinton administration, mind you. Bill Clinton himself, a zealot for housing as a right, even going on TV in 1998 to brag about how 85% of CRA loans were made during his presidency.
Something was supposed to have a civil rights impact that's largely economic, the Community Reinvestment Act, passed in 1977, over 20 years ago. Now, the Community Reinvestment Act was set up to say to the bank regulators, look, you guys go in and look at these banks and tell them, you got to take some of your money and invest it in inner cities, in neighborhoods, and with people who otherwise would not get it, so they have a chance to build homes, to build businesses, to create jobs, to build neighborhoods. In the 20-year history of the Community Reinvestment Act, 85% plus of the money loaned out under it to poor inner city neighborhoods has been loaned in the 5 years since I've been president.
Ooh, I don't know what aged worse, that statement or Bill Clinton. You'd think he would have learned his lesson after the failure of the Good Faith Fund, but I guess not. What this all adds up to is the magnification of the Community Reinvestment Act and the moral hazards it creates. The Clinton administration not only intimidated banks into following their arbitrary rewrites of the CRA, but making it insanely profitable for them to do so by selling them to Fannie Mae and Freddie Mac through mortgage-backed securities. The result is a vastly larger number of mortgages and debt circulating in the economy than otherwise would be, putting people in homes they could not afford, and they'll bankrupt themselves trying to. But, of course, this couldn't last forever. One could not only deduce that these loans would default through basic reasoning and logic, but there's piles of empirical evidence to back this up. When these loans defaulted, someone was going to hold that debt and has to eat these financial losses. What makes mortgage-backed securities so appealing is that banks didn't have to eat the loss at all. The loan was bought from them, so they make their money back whether or not the loan defaults. But the guys who bought the debt still have to eat the loss. So the question is, why? If they aren't going to make money, why do it? Given enough time, surely they'll all go out of business. Entrepreneurs will realize buying mortgages from banks, especially subprime mortgages, is unprofitable, so they'll stop doing it, leaving banks eating the losses. They're either exceptionally idiotic, yet smart enough to run financial institutions at all, or they have some guarantee that they won't lose money at all. Here's a story. In the 1980s, Robert Rubin, then part of the management committee of Goldman Sachs, helped Carlos Salinas, Secretary of Planning and Budget in Mexico, to protect the peso from currency shocks. As a reward, Goldman got to underwrite Telmex's public offering valued at $2.3 billion. Telmex being Mexico's telephone monopoly. This would lead to more contracts, and eventually, Goldman Sachs was buying Mexican government bonds. These bonds earned 12% interest, which was extremely profitable when paid with money borrowed from the US at 5% interest. However, government bonds are only as profitable as said government's ability to pay them. Naturally, the Mexican government was exceptionally corrupt and could not pay their bonds. This left multiple firms holding these bonds up a creek without a paddle. Goldman Sachs, for example, was facing $5 billion in losses. Now, in a sane world, this would have been a good lesson on prudence and risk. Rather than allow Mexico to default, however, on January 30, 1995, Clinton's Treasury Department announced $20 billion in credit for the Mexican government, while the International Monetary Fund, or IMF, gave them $17.8 billion, so Mexico could pay their bonds they owed to firms like Goldman Sachs. Wait a second. Robert Rubin was Treasury Secretary during that time. Before that, he was a manager and co-CEO of Goldman Sachs. What a coincidence. The infusion of credit was a transfer of risk from big Wall Street financiers to Mexican taxpayers who were now on the hook to pay for the Mexican government's debt to international governmental finance. In the late 90s, something similar was happening, with private Indonesian, Thai, and South Korean firms being unable to pay back loans worth billions of dollars. The Republican Congress was unwilling to bail out these Asian countries, so the Clinton administration worked through IMF to have them bail them out instead, ensuring Wall Street suffered no losses for their billions of dollars in investment. In addition to this, many financial institutions had the protection of their assets codified in government legislation. Banks had their deposits guaranteed through the Federal Deposit Insurance Corporation, which was a huge boon during the savings and loan crisis of the late 80s. The main difference is that whereas deposits are guaranteed under legislation, the investments of large firms were not, yet they were bailed out anyways. Following this successive string of bailouts, Why wouldn't finance believe that if they were in any real danger, they wouldn't just get bailed out? We also saw this in Russia, which offered bonds offering returns in the 20 to 30% range. However, it was to be paid back in Russian rubles, which due to Russia's ailing economy were dubious at best. However, investors marching on, believing Russia was too big, too nuclear to fail. As they, and I imagine you predicted, the Clinton administration came up with a $22.6 billion bailout for Russia. It didn't go as investors would have hoped, as Russia defaulted on their bonds anyways and devalued the ruble, leaving many to speculate that corrupt officials simply pocketed the money and ran, leaving many investors taking losses anyways. But we can appreciate the government forming the bailout mentality among investors and financial firms. Why should they care about risk when they pocket all the gains on their investment and the state assumes all the risk? As such, they are incentivized to make riskier investments and seek higher returns. As we shall see, this is coming to a head-on collision with your livelihood. But you want to know what's really criminal? How far we've come into the explanation of the 2008 financial crisis, and all we've talked about with the Federal Reserve was that they were founded. So let's get into their involvement. Now, Paul Volcker was Federal Reserve Board Chairman from 1979 to 1987. In that time, he implemented a new policy called inflation targeting, using the supply of money to control the growth or shrinkage of prices. A policy that would continue into Alan Greenspan's term as Fed Reserve Chairman. Most notably would be the aggressive expansion of the money supply to pull the US economy out of the dot-com bubble, which burst in 2001 and 2002. This was accompanied by a slashing of the federal funds rate. What that means is that if a bank has an excess of deposits it is required to keep in a Federal Reserve Bank by legislative fiat, it can lend that excess to other banks with interest. That interest rate is set by the federal funds rate. Anyways, Greenspan dropped the rate from over 6% in early 2001 to under 2% later that year, and it would go down to 1% the next year. In a free market, a low interest rate would signal high levels of savings, which would mean high levels of resources available to be speculated with. Thus, actors would be encouraged to spend, the resulting spending encouraging businesses to expand. Fannie Mae and Freddie Mac, who in addition to their easy access to credit from the government, can now borrow from investors at much lower interest rates. This borrowing fueled their own expansion, which meant buying more subprime mortgages, which meant more subprime mortgages. More mortgages meant a higher demand for houses. Home prices increased by 40% between 2002 and 2006, and between 2002 and 2007, mortgage-backed securities trading was valued at $2 trillion. Between easy access to credit, in addition to all this money being forced into the real estate sector by financial institutions, it was no surprise that industry involved in real estate saw massive growth in the early to mid-2000s. 4.6 million new homes were built between 2003 and 2006 to meet with that demand. Huge gains in the construction industry corresponded to a rise in the Dow Jones Industrial Average of 45% between 2002 and 2006. Credit was so abundant that firms borrowed up to $35 for every $1 they actually held. Banks would make mortgages without properly evaluating the risk. They were forced to make subprime loans by the federal government, and all the risk was gone because 1, they could sell the loan to Fannie or Freddie, 2, through mortgage-backed securities, and 3, they expected to be bailed out by the federal government even if they did fail. Let's not also forget the Federal Reserve's role as the lender of last resort. If there isn't enough liquidity, that is to say, assets don't have enough of an ability to be bought or sold quickly, the Federal Reserve will make loans to keep the financial institutions from collapsing. So what was happening is that in the mid-2000s, there was a housing bubble. The value of homes was artificially inflated due to easy access to credit and artificial demand created by mortgages being offered at artificially cheap rates. Because banks could count on the state to insulate them from the consequences of their malinvestment, provided they were large enough institutions, the perception was that they could enjoy all the profits of risk with none of the pitfalls. Of course, other non-financial institutions wanted to get in on it too. Real estate investors being a large component. People could get a cheap mortgage and buy a home and then flip the property, which is to say, renovate it to improve its value, then sell it for a higher price than bought for. Something especially popular if the expectation is that property values will continuously increase. In addition, insurance companies like AIG offered mortgage insurance packages to banks called credit default swaps. The way they worked is that the bank pays the insurance company a premium every month for the policy, and if the mortgage defaults, the insurance company pays the bank for the loss. The credit default swap business model relies on mortgages being paid back so the insurance company doesn't lose money on payouts. But this relies on mortgages not defaulting. Even Fed Chair Alan Greenspan recognized the gravy train can't roll forever. In 2004, he told Congress interest rates needed to rise to prevent inflation. The U.S. money supply increased from $4.9 trillion early 2001 to $7.4 trillion by 2007, so concern about inflation made sense. Interest rates are the price of money, and lower prices meant greater demand, which will eventually translate to greater supply. Greater supply of money leads to inflation. To prevent this, the Fed began gradually increasing the rate from 1% in 2004 to 5.25% in 2006. The result was what any Austrian economist familiar with the Fed's role in driving the business cycle expected. Once financial conditions for investment started to deteriorate, long-term projects or investments needed to be canceled. They just weren't profitable anymore. The lower interest rate of central banks created the illusion of savings which weren't actually there, leading to malinvestment. However, malinvestment translates to illiquid capital. Here's an example. Suppose you own a store and you want to build a second store. Well, you pay for the steel to build the new store, the brick and mortar, as well as the labor of contractors. Halfway through building it though, your customer base shrinks, and suddenly you can't afford the construction. So you fire all the builders and contractors, leaving you, the store owner, with a half-built building and several angry contractors. Your only choice is to fire the contractors and to sell the land as well as the materials. However, the capital already invested cannot be converted into other forms of capital, like the cash that your business so sorely needs. This is how malinvestment happens. Investors are tricked into believing the resources needed to complete projects exist through artificially low interest rates, signaling false levels of savings. In the case of the financial crisis, investors put money on properties that actually lost value, if only because multiple homes are foreclosed on in the neighborhood. The result is the destruction of capital. Economic firms eat the cost of their malinvestments and thus postpone future plans or downsize. This is what happened after February 2007, when single-family home sales peaked. Very early March 2007, the stock market plummeted and rebounded. On March 7, Bloomberg reports that 25 subprime mortgage lenders have either put themselves up for sale, declared bankruptcy, or just up and left. In April, the federal government encouraged banks to work with mortgage holders and borrowers on more flexible payment schedules, if only to stem the tide of foreclosures. Mid-June, home sales and prices begin to decline. 3 days later, big global investment bank Bear Stearns writes a loan of $3.2 billion to Bear Stearns High-Grade Structured Credit Fund, one of its own hedge funds that was bleeding money from subprime loan defaults. The loan was meant to keep the hedge fund solvent. July, still 2007, 1 month later, both that and the Bear Stearns High-Grade Structured Credit Enhanced Leverage Fund have lost nearly all of their value. American Home Mortgage Investment files for bankruptcy in August, with the Fed lowering interest rates from 5.25% to 4.75%. October, it is reported that private equity deals, that is to say, the transacting in shares of assets and companies not publicly traded in stock exchanges, has fallen from $177 billion earlier in 2007 to just $91 billion. In November, U.S. Treasury Secretary Henry Paulson persuaded Citigroup and Bank of America to set up a distress fund of $75 billion to buy up subprime mortgage debts. In December of 2017, foreclosures were up 97% from this time last year, while 1% of all homes in America are being foreclosed upon. With the projected GDP decline of the fourth quarter of fiscal year 2007, the U.S. officially enters recession. Bank of America begins their buyout of failing banks, most notably Countrywide Financial, which costs Bank of America $50 billion. The deal was made in January 2008. In February, Bush signs a tax rebate, but in March, the federal government loaned a total of $100 billion to banks who wanted subprime loans off their balance sheets. In addition, they offered $200 billion in federal treasury notes for holders of mortgage-backed securities who were otherwise unable to sell. Later that month, the federal alphabet soup allows Fannie and Freddie to take on another $200 billion in mortgage-backed securities. The Federal Housing Finance Board was also to take on another $100 billion in subprime mortgage debt. Now, I don't know about you, but I'm losing track of how much subprime mortgage debt the U.S. government is trying to guarantee just in March of 2008. But to give you a good idea of the scale of the crisis, the Federal Reserve announced it would guarantee Bear Stearns loans while also asking J.P. Morgan, another big financial institution, to purchase Bear Stearns. The reason? If Bear Stearns went under, its $10 trillion in securities would go poof, come to nothing. So of course Bear Stearns was too big to fail and couldn't be allowed to suffer the consequences of their actions. This pattern of financial instrumentation for the government to buy up subprime mortgage debt continued well into June. Come July, IndyMac Bank would go under. Treasury Secretary Paulson would make the TV rounds, asking for Fannie and Freddie to be bailed out. Around this time, the two government-sponsored corporations held $6 trillion of the nation's $12 trillion in mortgage debt. You can imagine what trouble they'd be in if those mortgages were defaulting. Congress would pass the ironically named Housing and Economic Recovery Act, with authorized $25 billion in loan guarantees to Fannie and Freddie, in addition to another $300 billion in FHA loan guarantees. It's September. The federal government nationalized Fannie and Freddie, bailing them out to the tune of $187 billion in stolen taxpayer money. They did pay it back with interest eventually, but the damage was done. Another mortgage giant, Lehman Brothers, filed for bankruptcy on September 15, 2008, the single largest bankruptcy in U.S. history. Dow Jones fell 504 points, and later that day, Bank of America offered to purchase Merrill Lynch for $50 billion. The next day, the federal government bailed out American International Group, or AIG, for $85 billion. Worried that the trillions of dollars in mortgages it held around the world would have collapsed the global financial system. The next day, September 18th, money market accounts saw a withdrawal of $144.5 billion. A typical day's withdrawal, $7 billion. On September 26th, Washington Mutual, or WAMU, went bankrupt after depositors withdrew $16.7 billion in 10 days. They were sold to J.P. Morgan for $1.9 billion. On September 29th, Dow Jones dropped 770 points, as a proposed bailout package is rejected by Congress. Congress would change its mind, and the Troubled Asset Relief Program, or TARP, would be passed by Congress on October 3, 2008, and eventually signed by President Bush. It was made to spend $700 billion of stolen money to remove subprime mortgage debt from the balance book of financial institutions. 4 days later, the Federal Reserve would directly issue commercial loans to businesses that would amount to $1.7 trillion. Another $540 billion was spent to bail out money market funds later in October. Come November, the federal government extends unemployment benefits for another 3 months, as many Americans are out of work by now. The federal government guaranteed another $1.3 trillion in interbank loans. the Federal Reserve announcing another $800 billion in purchases of mortgage-backed securities from Fannie and Freddie. Come December, the Fed has set their interest rates between 0.25 and 0. As automobile loans were hurting in the secondary mortgage market, the one where mortgage-backed securities are traded, the automobile manufacturers, GM, Ford, and Chrysler, get a bailout of $24.9 billion. Now, most people have a basic idea of what a disaster the 2008 financial crash was, but seeing these numbers gives you a real appreciation of the scale. The economy was on the verge of collapse, or so it's said, unlike anything previously. The propaganda from the crony corporatist big financial firms when their investments failed in Mexico, Southeast Asia, and Russia was that if they weren't bailed out, the economy would collapse. However, they only got bailouts in the tens of billions. In late 2007 and early 2008, the state was just throwing around a couple $100 billion every week. But in all fairness, they were hurting. The collapse of finances was exaggerated even further by a little-known accounting rule from the 70s called mark-to-market. Financial institutions were required by government regulatory fiat as part of their financial disclosure requirements to disclose the changes of value on their assets as gains or losses. Here's an example. Suppose you're a tiny bank. You have $100,000 in deposits and a house worth $50,000. Now imagine a nearby house burns down in that neighborhood. Not yours, of course. But property values go down because of it. Now you have $100,000 in deposits and a house worth $40,000. You didn't actually lose any money, but thanks to mark-to-market accounting rules, you have to mark the $10,000 drop in asset value as a loss. This caused banks to report losses greater than what they actually endured, as property values plummeted from the housing bubble burst. This scared many investors and depositors away, which resulted in actual losses for these firms. The incentive for banks, therefore, was to get as many foreclosures as possible, since that would allow them to recoup their losses. This would result in lower property values, which banks would be forced to mark as losses, creating a deadly feedback loop, exaggerating the problem. In addition, on May 26, 2005, AIG founder Hank Greenberg had a lawsuit filed against him by New York State Attorney General Eliot Spitzer, alleging accounting fraud to raise the company's stock value. He sought $6 billion in damages. These charges were filed under the Martin Act of 1921, which allowed fraud charges to be filed without needing proof of intent to defraud. In other words, under New York state legislation, the burden of proof is on the company to prove a negative that they weren't committing fraud. A running theme in government legislation, as you might have noticed. Spitzer alleged Greenberg was personally involved. His evidence? None. Witnesses? None. Claims to damage? None. The transactions in question would never have even been seen by Greenberg. That didn't stop Spitzer from going on ABC and telling George Stephanopoulos that Greenberg was a fraud. Even though he had no evidence, the damage was done. And rather than go through a lengthy legal battle or allow their good name to be dragged through the mud, AIG settled and forced Greenberg out of his company and to sell off his shares. Why this is important is because after Greenberg left, AIG doubled down on credit default swaps. Their subsidiary, AIG Financial Products, getting as many of the swaps in 7 months after he had left as they had gotten in the last 9 years. According to Greenberg, all of the internal risk controls that were in place were renewed upon his forced retirement. The result was that by June 30, 2008, AIG FP had $80.3 billion in credit default swaps, $57.8 billion of which was in subprime mortgages, with as many as $25.9 billion in losses due to mark-to-market accounting rules. Attorney General Spitzer did have a history of using his office to persecute people who he feels have slighted him, and Greenberg was a critic of Spitzer's. However, whether or not Spitzer deliberately had Greenberg removed so AIG would offer way more credit default swaps and thus exaggerate the problem, and was acting on behalf of executives Greenberg repeatedly derided, In addition to an obvious personal vendetta, I'll let you decide. The effect, however, was to worsen the financial crash. For many people, this wasn't an academic issue. People made plans and invested a lot more than just money into real estate and related industries. How many people put themselves through trade school to become electricians, plumbers, construction workers, expecting the housing bubble to continue forward only to graduate and more homes are now being foreclosed than sold? How many people trained to be real estate agents who ended up wasting all that time and money being educated and certified? What about people who cashed out their retirement plans, pensions, or life savings into a house, expecting home values to rise and sell for a profit, only to find that they were now underwater as their house was worth less than what they originally bought it for? It was devastating. The collapse of financial institutions like Bear Stearns left a lot of people without their 401ks, their pension plans. The collapse of several banks left many people and businesses without most of their deposits. Yeah, the FDIC insures deposits, but only up to $100,000, and sure, it got increased to $250,000 during the crisis, but if you had more than that in the bank, well, you're out of luck. And God forbid you were a homeowner that was underwater. Imagine buying a house for $1 million. Imagine moving into that house. Imagine making renovations on the house to sell it for more, only for it to be worth $750,000 the next year. This meant people literally couldn't afford to sell their house. Otherwise, they would have to eat the $250,000 loss, leaving them geographically trapped, which was especially bad if better economic activities were elsewhere, to say nothing of homeowners who couldn't afford their homes. As a result of government mandates and incentives, banks got people to sign up for mortgages they couldn't afford, not only locking them into the geographic traps mentioned earlier, but leaving them on the hook for monthly payments, property taxes, utility bills, and other expenses that comes with owning a home. If the family couldn't afford it, they would have to declare bankruptcy. The bank would then repossess the house, as well as the assets used as collateral for the mortgage. The bankruptcy alone would ruin someone's credit rating, making it harder for them to get loans in the future, leaving the family worse off economically than if they had just not gotten the mortgage in the first place. Which circles back to where we started. A lot of people were hurt. Forget about rebuilding. They're still wondering what the hell just happened. So, what did happen? Well, you've watched this video, so you've gotten a pretty good understanding. You probably don't remember all the details, but you got a basic idea. So, let's review. The National Housing Act of 1934 makes it more expensive for lenders to offer mortgages in areas suffering from infiltration of a lower grade population. In other words, forcing banks to commit redlining. After its repeal, community agitators in the 60s and 70s demand an end to redlining. Congress passes the Community Reinvestment Act, forcing banks to offer mortgages to poor communities. Using a hilariously flawed study from the Boston Federal Reserve, the Clinton administration from 92 to 00 extended the CRA to encompass all lending institutions through regulatory fiat, making the requirements stricter while fostering a bailout culture that made financial firms believe that if the risk was too great, Washington would make good on their investment anyways. To pull the US economy out of the dot-com crash of 01 and 02, the government inflated a housing bubble through lower interest rates, causing home ownership and home prices to skyrocket. The bubble bursts and property values plummet following the Federal Reserve raising interest rates again. People can't afford their mortgages, and financial firms take huge losses from defaulting mortgages. Made even worse, with mark-to-market accounting rules requiring them to record losses of property value as losses even if they don't lose any money. But here's the thing. There isn't any one program people can point to and say, aha! It was a perfect storm of a dozen or so factors. Remove one, and things would have still collapsed as they did. Maybe it wouldn't have been as bad, but this was happening one way or another. But there is one commonality. All of these factors are a result of government intervention in the economy. The government caused the 2008 financial collapse. But of course, this didn't stop the state from turning their propaganda machine into high gear. The narrative they crafted as the crisis was happening and after, it was the free market. Wall Street bankers just got greedy, you see. They forced poor people to buy mortgages they couldn't afford. This is not the full narrative, but you'll often see it nonetheless. The greed argument falls apart immediately because greedy people hate to lose money. And offering subprime mortgages for little to no money down is just too risky. The only reason any greedy person would entertain it is because the government subsidizes the secondary market of mortgage-backed securities and credit default swaps, insulating lenders from the risk. So even if we assume all bankers are motivated purely by avarice, the government is still responsible for the events. Also, advertising isn't mind control, so the whole forced poor people doesn't make a whole lot of sense. But let's go into some of the statist narratives and take them apart. The first one goes something like this. There was too little regulation in the economy. The Wild West world of Wall Street brought the country to its knees. This argument is so overused it's a cliche. Whenever anything goes wrong, ever, it's always because people have too much freedom, and we need to get the state to restrict people's voluntary activity such that a crisis like this never happens again. Sadly, this argument appeals to people indoctrinated into the religion of statism to view the government as the savior, to uplift them from the woes of individual liberty, whose first instinct when trouble is afoot is to call the police. The trouble with this hypothesis is that it assumes so-called regulators have special knowledge to prevent these kinds of economic catastrophes. If this was the case, then why would they be working in the government? They should be building firms that acted exactly how they wish to restrict other businesses into acting, and they would become millionaires, even billionaires. That this doesn't happen is proof enough that they're full of it. Often the term free market gets thrown around, as though the problem was that we have too much of a free market. The trouble is, they don't define what a free market is. Generally speaking, it is a market economy absent any government intervention whatsoever. Right away, this argument falls apart. If there are central banks, licensing regulation, minimum fees, zoning laws, certifications, approval processes, taxation, and other forms of restriction on economic activity by the state, yeah, we don't have a free market. But that's a general argument. More specifically to the 2008 financial crisis, well, often those who make this argument don't specify which economic restrictions would have helped. If they want to be specific, well, they claim that if the Glass-Steagall Act hadn't been repealed, lenders wouldn't have been able to repackage mortgages into mortgage-backed securities and sell them off to the secondary market. Because of this, it is argued, lenders can be more reckless than if they had to keep those toxic mortgages on their balance books. At first it makes sense, since if banks couldn't sell off subprime mortgages, they would have been disincentivized from making so many. However, this argument falls apart pretty quickly too. Fannie and Freddie were buying mortgage-backed securities from financial firms before 1999 when Glass-Steagall was repealed, so this legislation wasn't doing much even when it was in place. Secondly, it assumes that secondary market investors are stupid, that they didn't understand the risk of debt they were purchasing but wanted to buy it anyway. The only reason this would be the case is because incompetent firms were prevented from failing when they were in trouble in Mexico, Southeast Asia, and Russia. The third explanation is that banks were confident that any losses they incurred would be deferred onto others. Given the aforementioned bailouts and guarantees from and to Fannie and Freddie from the state, making subprime mortgages was only rational. Either way, the argument that there was too little restriction on voluntary economic activity does not work. Finance is one of the most heavily restricted industries in the US, second only to perhaps nuclear energy. The idea that it was due to too little regulation not only conflicts with observable reality, but deflects from the now blatantly obvious fact that the US government was responsible for the crisis to begin with. This also debunks another statist argument, that regulators were just asleep at the wheel. We already know government caused the problem, so the idea that they were inactive flies in the face of reality. This hypothesis contradicts the argument of too much economic freedom as well, since the fell asleep argument implies that the proper economic restrictions were already in place, just not enforced. Which simply begs the question, is the state even competent to prevent the problems it claims it can prevent? Or will they just be asleep at the wheel the next crisis? But I can assure you one thing though, the problem was not because of a few bad actors. Another statist argument is that there was a massive global savings glut. Now I confess I had never heard this one. I only saw it when I was doing research for this video, but there's a not zero chance you, dear viewer, might hear it repeated to you, so I might as well address it. The argument goes something like this. Other countries were saving too much money. Developing Asian countries had a trade surplus with Western countries, and the theory goes that the flow of capital resulted in lower interest rates, which is what triggered the housing bubble. However, no date as to when this happened is given. When Ben Bernanke first made this argument, he pointed to a 2004 analysis of trade to make his point, even though the housing bubble began in 2001. It also fails to explain why Asian countries would save more while ignoring the ability for foreign countries like China to simply print new currency to give themselves the illusion of savings, even if they weren't actually saving. It also pretends that the Federal Reserve is merely a passive observer, setting interest rates according to foreign trade. That the Federal Reserve lowered interest rates to 1% to get the US out of the dot-com crash in 2001 carries a lot more explanatory power. Now, why the government pursued the policies that they did, well, barring some extraordinary evidence of a conspiracy to bring the US financial system to its knees, these factors, the Community Reinvestment Act, their strengthening by Bill Clinton's Department of Housing and Urban Development, the ousting of Hank Greenberg at AIG, and more, are independent of one another, each consisting of multiple politicians seeking power, money, glory, or all of the above. Some might say that these people were well-intentioned, and to them I say, you're funny. The National Housing Act and the Community Reinvestment Act give the states the power to dictate the lending policies of banks and manipulate where people live. Being able to alter demographics on a whim to suit the interests of the state at that particular moment in history. I hope I don't need to go into why the state wants central banking, that is to say, having a monopoly on currency and being able to print and borrow money to facilitate its own endless spending, as well as dictate the rates of spending and saving through interest rates. But we're coming to the most tragic part about this story. All of these factors that crashed the economy 11 years ago, the CRA is still on the books. The economic restrictions written in the 90s are still in place, and new champions of housing as a right are in Congress today. The CRA was made even stronger through the passage of Dodd-Frank in 2010. Austrian economists, many of whom successfully predicted the 2008 financial crisis, are seeing an everything bubble forming and beginning to burst. What happens then? Who will be hurt? I don't know. But I know one thing with absolute certainty. The first movie was a bomb. I hope you're ready for the sequel, because second verse same as the first. Total economic collapse will be threatened. Companies that should have failed so malinvested capital can be sold for more productive projects will instead be bailed out, using trillions of dollars of stolen taxpayer money. The government will be the cause of the crisis, though the free market will be blamed that never existed to begin with. The question remaining is what happens after? Well, we're writing that history as we speak, aren't we? Questions, comments, critique? Do you remember the 2008 financial crash at all? I know there are people in my audience too young to remember the crash, so everything they know about it comes from government indoctrination, hence the need for this counter-narrative. Let me know in the comments below. Support me on Patreon. Like, share, and subscribe to become a heretic today.